In this video, we're going to talk about some closing process concepts. And one of the key concepts you have to understand is the difference between temporary accounts and permanent accounts. Temporary accounts are the revenue, expense, and dividends accounts. So basically anything on the income statement is a temporary account, and also dividends, which is on the retained earnings statements, that's a temporary account. So those are all temporary accounts. So what's the point of temporary accounts? Well, remember, if you look at the income statement, right? The income statement is a period of time statement. It tracks activity from one period to the next. So it can track activity for a month, for a quarter, or for a year. So if you want the income for 2021, then at the beginning of 2021, you're going to start at zero. You're going to accumulate all the income and expenses for that year. And then when you get to 2022, guess what? You've got to start at zero again. Why? Because it's only tracking activity for a specific period of time. Okay, so revenues, expense, and dividends, these are period of time accounts. They track activity over a period of time. So when the period is finished, then you have to start over at zero. So what is the closing process? The closing process is zeroing out the temporary accounts. That's the whole point. It's making these income and expense accounts and the retained earnings dividend accounts, making those zeros so that when you start a new period, they track activity. Because when you get to 2022, you don't want to have income from 2021 still in the account for 2022, because now that 2022 information is going to have 2 years of data, and you don't want that. So temporary accounts are revenues, expenses, and dividends, and the whole point of that is to zero these out and get ready for the new period. So the temporary accounts track activity for the period. They start at zero every period. So every year, every month, every quarter, they start at zero. And you can think of it as starting a new semester. In school, every semester, you start fresh. You start new. You start over from zero. It doesn't matter what happened last semester. Every semester is a new semester, and you start off on a level playing field with everyone else, and you can accumulate grades to do your very best. Well, that's the complete opposite of permanent accounts. So permanent accounts are asset, liabilities, and equity accounts, and permanent accounts are the balance sheet accounts. So these are not temporary accounts, right? So the balance sheet accounts, the balances carry over from one period to the next. So if you think about your cash balance, at the end of the period, at the end of 2021, you have $1 million in cash. When you start 2022, you don't make the cash zero. The cash carries over to a new balance. Accounts receivable is what customers owe you. If customers owe you $500,000 on December 31st, on January 1, that balance doesn't automatically go to zero. No, it just carries over to the next period. So for permanent accounts, assets, liabilities, and equity, these are permanent accounts. And whatever the balances are at the end of the period, it carries over to the new period, right? So these are, you can consider them cumulative totals. So remember, we use the analogy for temporary accounts like starting every new semester. But when you start school, even though you have a spring semester and a fall semester, and every semester is a new completely fresh semester, there is something that's called the cumulative grade point average, right? And what that does is it tracks activity from the first time you start school all the way to the current semester. So even though each semester is a fresh start, your cumulative average is taking the cumulative balance of all those semesters together and telling you, okay, what's your grade point average right now, considering everything. And that's what a permanent account is. Permanent account tracks the activity in an account from the beginning of the creation of that account all the way to the current time. So permanent accounts, the balances carries over from one period to the next. Temporary accounts, they zero out. And the whole point of the closing process is to zero out these temporary accounts, to make revenue zero, to make expenses zero, to make dividends zero, right? And we'll go through the steps that you take to actually make that happen.